Welcome to the Opening Bell Report.
Have you ever looked at the markets and just seen total unadulterated panic?
Oh, yeah. The kind where logic just goes completely out the window.
Right, exactly. You know the scenario. It's when everyone is aggressively running for the exits, the charts look fundamentally broken, and there is just absolute
Blood in the street.
blood in the streets. Yeah. If you're managing a portfolio, it can be, terrifying to watch a position gap down like that. But if you've been paying attention to market history and if you trade based on data rather than emotion, you know that this exact kind of widespread indiscriminate panic often creates the most incredible mispricing.
It really does. When the institutional algorithms and the retail traders are both just selling on pure negative momentum, the underlying fundamentals completely get ignored.
And that is exactly the setup we are looking at today. We have our hands on a fascinating analysis report titled Down 60%, Why the Impinj Sell-Off Could Be a Massive Opportunity.
Yeah, and for those tracking it, Impinj trades on the NASDAQ under the ticker symbol PII.
PI, right. And we are going to tear into exactly what is happening under the hood here, because the divergence between the narrative and the actual numbers is, well, it's absolutely shocking.
It really is a massive divergence. I mean, this is a classic case study in how the market ruthlessly punishes short-term uncertainty while entirely missing the long-term structural evolution of a business.
Totally.
We're looking at a situation where the underlying operational efficiency and the stock price are moving in completely opposite directions, which is exactly where you want to look if you're hunting for asymmetric risk-reward setups.
Right. So let's lay out the reality check for you. If you pull up a chart of Impinj right now, brace yourself because it is an ugly picture.
Very ugly.
This stock has been absolutely battered. It has plummeted over 60% from its 52-week high. We are talking about a drop from a peak of $247.06 all the way down into the mid-90s.
That is a brutal haircut for anyone who is holding at the top.
Yeah, it wipes out billions in market cap. And there is a very specific, tangible catalyst for this crash. Management came out and delivered a brutally conservative guidance cut for the first quarter of 2026.
Yes, and we know the market hates uncertainty, right?
Right.
But it aggressively punishes missed expectations, especially for tech hardware names that are, priced for perfection.
Oh, absolutely.
Impinj projected their Q1 2026 revenues to come in roughly 20% below what the consensus on Wall Street had modeled.
20%? That's huge.
It is. The Street was expecting a steady $90.5 million, and Impinj guided for a range of just $71 million to $74 million.
Wow.
Yeah, you drop a 20% top-line miss on a high multiple tech stock, and a 60% haircut is exactly the kind of algorithmic reaction you're going to get.
Okay, let's unpack this. Because that revenue miss is the headline that caused the massive sell-off. The market is pricing Impinj right now as if its entire growth thesis is permanently broken.
Right. Like it's unfixable.
Exactly.
Yeah.
It's treating this guidance cut like the company has hit a structural brick wall that it simply cannot climb over. But the mission of our deep dive today is to look past those scary top-line headlines and dig into the actual data in this analysis report.
Which tells a very different story.
Right. We need to figure out, is this a fundamental failure of the business model, or is it just a cyclical channel digestion? Because if it is the latter, and the market is just misinterpreting a temporary hardware cycle, this 60% drop could legitimately be the entry point of the year for the patient investor.
What's fascinating here is how entirely Wall Street hyper-fixated on that top-line revenue miss, and in the process, completely ignored the massive underlying improvements to Impinj's actual business model.
They just looked at the drop in rain.
Exactly. They looked at the 71 to 74 million revenue guidance, panicked, downgraded the stock, and basically stopped reading the rest of the 10K.
Yeah.
But if you look closely at the actual cash generation, you realize that Impinj is fundamentally a much stronger, more resilient company today, trading at $98 than it was when it was trading up around $240.
Now, I have to push back on that a little bit because that sounds completely counterintuitive to anyone just looking at the top line. I mean, if they're bringing in 20% less revenue than expected, how can they possibly be a stronger company?
That's all about the efficiency.
Walk us through that shift then, from being a cash burner to a cash machine. Because the analysis report highlights a really stark contrast between 2023 and 2025. Back in the high growth, zero interest rate narrative days of 2023, Impinj was burning through cash to fuel its expansion.
Right.
They burned $68 million in cash that year just to capture market share.
Exactly. That was the classic growth at all costs tech playbook. Everyone was doing it. But fast forward to the full year of 2025, and the picture is completely inverted. Management didn't just trim the fat, they completely optimized the unit economics. In 2025, the company generated $45.9 million in free cash flow on $361.1 million in sales.
So wait, they flipped a negative $68 million burn into a positive $45.9 million cash generation.
Yep.
all while operating in a tough macro environment for hardware.
Yeah.
That is seriously impressive. Generating $45.9 million on $361.1 million in sales translates to a free cash flow margin of 12.7%.
Right.
And for a SaaS company, maybe that's standard, but for a company that manufactures and ships physical hardware components, maintaining a 12.7% margin is incredibly difficult.
Extremely difficult.
It proves that their business model actually scales profitably once that initial infrastructure is laid down.
It proves serious operational leverage. And the trajectory is what really matters here, too. If you isolate the most recent data from the fourth quarter of 2025, that free cash flow margin actually expanded even further to 14.7%.
Wow, good.
Yeah, that shows severe operational discipline from management. They aren't just coasting on legacy contracts. They are actively becoming more efficient at squeezing actual cash out of every dollar of sales right at the exact moment the market is pricing them for death.
And this operational discipline is exactly what has allowed them to build what the data correctly identifies as a bulletproof balance sheet. The balance sheet numbers are wild when you compare them to the sheer panic in the stock price.
They really are.
Impinj ended 2025 with a record $279.1 million in cash and short-term investments. Right. Compare that to their long-term debt, which sits at only $184.1 million. It's like having a massive emergency fund that makes taking a temporary pay cut way less terrifying.
Exactly. They are operating from a net cash position. In an environment where the cost of capital is elevated and debt refinancing is a legitimate existential threat for a lot of mid-cap tech hardware companies, Impinj is sitting on a fortress.
A fortress, yeah.
They are not at the mercy of strict creditors or dilutive equity raises to keep the lights on. They have the financial runway to comfortably survive a cyclical downturn, absorb the revenue hit in Q1, and just weather the storm without fundamentally impairing shareholder value.
But that begs the obvious question for you listening.
Yeah.
If you're tracking this, you have to be asking, if the fundamentals are this strong, if they're generating record cash flow, expanding margins to 14.7%, and sitting on a mountain of net cash.
Right. Why the massive revenue drop?
Exactly. Why are sales slowing down so sharply in early 2026? You don't guide down 20% if everything is firing on all cylinders.
And that brings us to the macro context. We have to look at the broader supply chain ecosystem to understand the why behind the drop. The analysis report frames this as a classic inventory digestion cycle.
Inventory digestion.
Yeah. To be clear, the data shows Impinj is not losing market share to competitors. Their technology remains top tier. What happened is that their enterprise customers simply ordered way too much product over the last 8 quarters, and now the entire channel is suffering from what the report brilliantly calls a logistics hangover.
A logistics hangover. That is the perfect way to describe the aftermath of the post-COVID supply chain panic. We all remember how chaotic that was.
Yeah, it was a mess.
Global logistics networks were paralyzed. So, major logistics players, massive retail partners, they all completely freaked out and initiated a massive supply chain digitization frenzy. They realized they needed to track literally everything in their system at the item level.
Yep.
And in doing so, they heavily stockpiled Impinj's older M700 RFID chips. They abandoned all their lean inventory models and just ordered way more than they needed to guarantee allocation.
It was a massive structural shift from just-in-time inventory to just-in-case inventory.
It's the case, right?
Procurement managers were terrified of stockouts, so they double and triple ordered these M700 chips. But now, global supply chains have largely normalized. Freight is moving. Consequently, these massive logistics and retail companies are sitting on warehouses completely full of these older M700 chips.
I see.
We are currently in a transition period. These customers are simply burning through their excess inventory. They have no immediate need to place massive new orders with Impinj right now, not because they don't want the tech, but because they are still chewing through the stockpile they built up in 2023 and 2024.
Well, wait, I have to jump in here because this is where a skeptical investor should be raising a red flag.
Go for it.
If these enterprise customers are sitting on massive stockpiles of the older M700 chips, and Impinj is actively transitioning to ramping up production of its newer custom endpoint ICs, isn't there a massive risk that this old inventory just becomes obsolete dead stock? Like, why would a logistics giant burn through old tech if the new custom ICs are available? Couldn't this result in massive write-downs across the channel?
That is exactly the right question to ask, and it's why the market is so spooked right now. But you have to understand the mechanics of RFID adoption.
Okay.
The M700 is a standard, highly reliable mass market chip. It is perfectly viable and frankly preferred for standard bulk tracking like tagging massive pallets or basic retail inventory.
Like the everyday stuff.
Exactly. The newer custom endpoint ICs are designed with specialized memory or cryptographic security for very specific higher value use cases. So the customers aren't going to throw the M700s away, they are going to use them for their baseline tracking needs.
Makes sense.
But because they know the custom ICs are coming for their advanced needs, they are putting a strategic pause on all new generalized ordering until their current baseline stock is depleted and they can properly map out their upgraded infrastructure.
Ah, okay. So it's a strategic pause, not an abandonment of the technology. The customers are recalibrating their deployments.
Exactly. If we connect this to the bigger picture, this kind of digestion air pocket is incredibly common in the tech hardware space. Hardware cycles are notoriously lumpy. You don't get perfectly linear up and to the right growth.
Never happens.
Right. You get periods of massive over-ordering driven by macro fears, followed by periods of digestion where the channel dries up, followed by another massive upgrade cycle. The analysis report projects that the channel will likely clear this excess M700 inventory by the second half of 2026.
Meaning that for the next couple of quarters, the numbers might still look a bit ugly, but by the back half of the year, those massive stockpiles will finally be depleted, and these logistics companies will be forced to come back to the table and start ordering the new custom ICs.
Yes, and when they do return, ordering patterns will normalize back to actual consumption rates because the underlying demand hasn't evaporated. The fundamental desire for item-level IoT tracking the Internet of Things remains a massive, multi-year secular tailwind. The enterprise customers still desperately need to track their global inventory. They just need to finish deploying the chips they already bought first. The structural thesis is completely intact. The timing is just delayed.
Here's where it gets really interesting, because this massive 60% sell-off has completely recalibrated the math on investing in this company. We are looking at a classic valuation reset. If you manage a GARP portfolio growth at a reasonable price, Impinj probably wasn't even on your radar for the last 3 years.
Not a chance.
Because for years, you had to pay an absolute nosebleed premium to own this stock. The speculative froth was incredibly thick, but looking at the data now, the froth is officially gone. Let's look at the peak narrative from 2022 to 2024 versus the current reality in early 2026.
The multiple compression here is staggering when you put the valuation metrics side by side. It is a completely different risk profile today.
Right, let's run the numbers. At its peak, Impinj's forward PE ratio was floating in the stratosphere, somewhere between 80x and 150x forward earnings, depending on the quarter.
Just massive.
Investors were paying for flawless execution 10 years out. Today, that forward PE has dropped down to roughly 34x on a non-GAAP basis. The price-to-sales ratio was historically trading over 15x. Now, it has plummeted down to 8.0x.
The huge drop.
And the total market cap of the company has shrunk from over $6 billion at its height down to roughly $2.9 billion today.
For anyone analyzing these multiples, the takeaway is clear. The hyper-growth premium has been entirely watched out. Now, let's be objective here. Trading at 34 times forward non-GAAP earnings, which, we should note, adjusts for standard tech stock-based compensation, and 8 times sales means Impinj is not suddenly trading in deep value territory.
Right.
You wouldn't look at this and compare its multiples to a mature utility company or a legacy bank. It is still priced for growth.
Right. A 34x multiple on a company that just guided revenue down 20% is still a premium. Some value purists would say that it's still way too expensive for a hardware company entering a cyclical downturn.
They might, but you have to factor in the moat. Those new metrics are actually much closer to historical norms for a high-margin dominant player operating as a near monopoly in a highly specialized hardware ecosystem.
That makes sense.
You are paying a premium for market dominance and that 14.7% free cash flow margin, not for speculative future adoption. The stock has been de-risked significantly.
How so?
Well, when you buy a stock at 150 times earnings, literally everything has to go perfectly for years to justify that price. Any slight bump in the road, like a totally normal inventory digestion cycle, will cause the stock to implode, which is exactly the 60% drop we just witnessed.
Right, the margin for error is zero.
Exactly. But when you buy that same dominant company at 34 times earnings, a lot of the cyclical bad news is already priced into the asset.
So what does this all mean for you? If you're sitting there looking at your portfolio architecture or you're updating your watch list to find heavily discounted tech infrastructure plays, how do you actually translate this data into an actionable strategy?
That's the key.
Because identifying that a stock's valuation is reset is only half the battle. Knowing the optimal structural entry point is what actually generates alpha.
The analysis report actually provides a highly specific technical setup for how to play the chart right now, acknowledging that the fundamentals and the technicals are finally aligning.
Right, let's talk about those technical levels, because you don't want to just blindly buy a falling asset. According to the data, The stock is currently trying to build a base right around the mid-90s.
Yeah.
This isn't just a random number. It's an important psychological and structural area because it sits directly on the stock's pre-2023 breakout levels. It's a major volume node. And the chart shows that if this mid-90s base fails to hold, there is heavy, multi-year technical support sitting just a bit lower, right around the $85 mark.
Which brings up the golden rule of trading these kinds of aggressive cyclical drawdowns. Never try to catch a falling knife by deploying all your capital at once.
Yeah, that's a quick way to lose a lot of money.
The market is highly emotional right now. When a stock is dropping sharply, dumping your entire allocation in at $98, hoping you magically sniped the exact bottom, is a surefire way to get shaken out if it drops another 10%. The strategic approach advocated here is scaling in through tranches.
Right. Acknowledging that we can't predict the exact bottom, but we can manage our cost basis. The strategy outlined is to initiate a starter position here in the mid-90s while it tries to consolidate and build this base. You get skin in the game.
Yep.
But you purposefully keep dry powder on the sidelines. If the macro environment weakens further, or if algorithmic selling pushes the stock down to test that heavy technical support level at $85, you step in and add heavily to your position there.
Precisely. By structuring the trade that way, you are mathematically lowering your average cost basis right at the point of maximum historical support. It creates an incredibly asymmetric risk-to-reward ratio for a long-term hold, assuming you believe in the eventual clearing of the logistics hangover in the second half of 2026.
It systematically takes the emotion out of the trade. You aren't panicking if it drops from 95 to 85. You are actually welcoming it because you have a structured plan to exploit that liquidity.
Exactly.
It's all about patience and letting the hardware cycle play out. So to quickly synthesize the mission of today's deep dive, we looked at a massive 60% drop in Impinj's stock price, triggered by a highly concerning Q1 guidance cut. But by looking under the hood and parsing the data, we see that this top-line drop is being driven by a temporary, cyclical channel digestion.
That's right.
And that short-term headwind is entirely masking the fact that the company has fundamentally evolved into a highly disciplined cash machine, sporting expanding 14.7% free cash flow margins and a completely bulletproof balance sheet with zero net debt anxiety.
This raises an important question, something for you to seriously consider as you look at the future of global commerce over the next decade. The analysis report anchors its thesis on the fact that the underlying demand for item-level IoT tracking is a massive secular tailwind that isn't going anywhere.
It's here to stay.
If we are genuinely moving toward a world driven by this tailwind, where literally every physical item, from a massive shipping container crossing the Pacific down to a single designer t-shirt sitting on a retail shelf, has a digital twin tracked by these RFID chips and custom ICs. What happens when the companies supplying this invisible infrastructure become as foundational to global commerce as the utility companies that provide our electricity or the telecom giants that provide our internet?
That's wild to think about.
When this current inventory hangover inevitably clears in late 2026 and the ordering cycle ramps back up, are we looking at a tech hardware monopoly hiding in plain sight, currently priced like a distressed asset?
That is a phenomenal and fascinating thought to leave on. The invisible infrastructure of the future supply chain is being priced today as if its growth story is over. We want to thank you for joining us on this deep dive. Keep questioning those flashy, panic-inducing headlines, keep looking past the top-line noise, and keep searching for those asymmetric, hidden opportunities in the data. We will see you next time.
Don't forget to like, share, and subscribe for more.